Now, of course, the budget, if you hadn't heard, it's
Yes.
coming down on Tuesday, and it's a chance, I guess, to look at the nation's financial health. Maybe also a chance to look at your own personal financial health too, because, of course, the end of the financial year, not too far away now, really. However, with the end of the financial year, perhaps it's time just to work out what you can do to maximise your own financial position.
Get all your documents together. Well,
Yeah.
Suzanne Haddan is the Managing Director of BFG Financial Services and is here to give us her top tips, particularly around superannuation. Suzanne, thanks for coming in.
Good morning.
There have been some changes in terms of super. What should people be keeping in mind when doing their tax?
So the first big change in super is the ability for employees to be able to contribute their own money to super and claim a tax deduction. Historically, you've had to salary sacrifice and trust that your employer will do it on time and get the money in at the right time to use your level. But now you can put your own money in. And let's remember, for the average worker, whatever you put in, you probably save 20% tax. Plus, it can be used for the new First Home Super Savers scheme. My tip here is just remember there's a limit. It's $25,000 for all Australians, and you've got to take into account whatever your employer's putting in. You know, your 9.5% super guarantee and any other contributions.
It does seem to be fairly complicated, though, particularly when you're contemplating at a tax time, because not only your own contributions, you can do co-contributions, contributions from your spouse. That just further complicates the matter, doesn't it?
Isn't that great? As an advisor in this space, as an accountant, it's fantastic. But there are some other opportunities I think you need to focus on. Let's look at for the lower income earners. What's in it for them? The old favourite of being able to put $1,000 into your superannuation from your own money and get $500 from the government. That's a 50% return on that money. The problem is that when you're a low income earner, and we're talking people under about $37,000 here to get the full benefit, it's hard to find the money.
That's a lot of money, yeah.
So my tip is try to put a little bit in each week, maybe around the $20 mark, and at least get in on the action for what you can get from the government for super.
So how can you be utilising your spouse's income to benefit you at tax time?
Sounds good, doesn't it?
Yeah.
There's two major areas. The first is that I wanted to highlight, which was a change in the last budget, is about spouse super contributions.
Right.
And if your spouse is now earning under $37,000, where it used to be under about $11,000, you can put $3,000 into this super and get $540 rebate. That's an 18% return. You get something up to $40,000, but it reduces. The other one, which is really important, is we call it spouse super splitting. And I've said before that I want couples to view super contributions coming into the family as family contributions, and you're able to transfer 85% of the pre-tax contributions, your super guarantee, salary sacrifice, over to your spouse after the financial year end. And it helps balance between the couple, because we often see particularly women taking time out of the workforce and not getting the super support. So I think there's a couple of strategies there.
And you've already mentioned the super savers account as far as first home buyers are concerned.
Yes.
Is everyone making the most of that, do you think?
No, because that's very new. The first time you can actually withdraw is 1st of July 18. But in broad terms, what I would say there is by using the Super Saver scheme, you're probably going to improve your first home savings by about 30%. So hopefully that'll get your attention. And there's some good websites, the moneysmart.gov.au, and there's a new government site that will explain and have a calculator as well.
Now, speaking of complexity, there might be some people who might be trying to maximise their money by investing in an Airbnb, buying a property, not necessarily renting it out in the normal way, but using it as an Airbnb. But there are some complex rules around that when it comes to tax time.
There are, and it's crossing our desk quite a bit at the moment. So we're talking more about the people that have their own home, might rent a room or two. Most people are aware they need to put the income on their tax return, I hope they're aware, and claim their deductions. We see quite a trap around capital gains tax. You're probably aware that your own home is generally exempt from tax when you sell it, but not when you've been doing Airbnb. Now, how it works is you've got to look at the floor area. So if you're renting out 1 or 2 rooms and that's 20% of your house, you could be affected by 20% of the gain. So my tips here are You must get a valuation of your property at the time you start Airbnb, and that protects the capital gain that you've already made when you've owned it previously.
Yeah.
Record every expense. Don't try to judge whether it's relevant, because it might be a renovation on your bathroom rather than B&B, and that'll reduce your tax. And the last tip is check. It's hard. Try to estimate the capital gains tax that might occur and compare whether renting out that room is going to be worthwhile.
Also, more broadly, as far as deductions are concerned, I think this is a bit of a nightmare for the tax office, because it almost seems deductions are unlimited, and no doubt a lot of people perhaps claim more than they should. Is it an ongoing problem? Do you think the government is going to take a closer look at this?
Oh, they constantly look at this, and we're expecting in the budget, rumours out that they might limit the deductions as employees, work-related deductions. They warn us as tax agents periodically, this is what we're focusing on. It shouldn't be a national pastime to claim deductions you're not entitled to. So keep your records is my tip.
That's the big tip. Keep your records, but also perhaps seek professional advice.
Yes, we like that one, Johanna. Thank you.
No worries. All right. Thanks, Suzanne.
Thank you.